Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And on the program tonight, I catch up with Rudi Filapek-Vandyck to flesh out this question. Is this stock market of ours trying to bottom, or is it something that's going to happen later on down the track? So far, I've talked to Shane Oliver from AMP. I've talked to Michael Knox from Morgans and Rudi, and neither of those three people believe the bottoming process is actually happening right now. They think another leg down will actually happen sometime down the track, but they do see stocks rebounding later in the year. We'll catch up with Rudi, and he also looks at some of the stocks he thinks looks like really good value right now. And then I catch up with Kelli Meagher from Sage Capital, portfolio manager there. And Kelli likes Domino's and she likes REA, but she too thinks there's going to be a few more challenges, particularly after reporting season. And then finally, Helen Tarrant, a property expert, looks at why commercial property is looking like a really good deal right now. That's the program. Let's kick off now with Rudi Filapek-Vandyck from FN Arena. Well, joining me now from FN Arena, the founder of FN Arena, is Rudi Filapek-Vandyck. How are you, Rudi?
I'm fine, Peter. I hope you are too.
Yeah, I am. And it comes at a pretty special time where lots of people would be wondering whether what we've seen recently is either the beginning or maybe even the middle of a bottoming process, or is a false dawn. And I thought this is a great topic for you and I to start off on, because essentially, even though we've been great friends for a long time, there are certain differences that we're both well aware of. I tend to be a little bit more optimistic than you, though you are optimistic, but you show caution within your optimism as well. And both of us use the history that we've been involved in studying markets and studying companies. But I also thought it'd probably be worthwhile checking out the character of Belgians, because you are Belgian, aren't you?
I am, definitely.
And so I've gone to the source of all knowledge, namely Google, and it tells me that Belgians tend to be tolerant, flexible, modest, and open-minded. That sounds like you to a T.
And we like good food.
Yes, they value privacy, enjoy a safe and comfortable life, work hard, and are self-disciplined. And that safety comes in sometimes in your view that you won't jump on board an optimistic run too early, which is pretty good for investing as well. Belgians tend to be very involved in their communities and government. And I thought you'd like this one. This came from one of those sort of travel websites. What are Belgian guys like? I'm sure that was a question that, well, I might ask the question, who might have asked that question? Because nowadays we're in a new world. Belgian people are generally known to be polite, softly spoken, and extremely well-mannered. In fact, men will even rise sometimes when a woman enters the room to show respect, or stand on public transport until a woman is seated. Rudi, this is you all over. Did you write this about yourself?
Must be, Peter. Must be my ghostwriter.
So I thought it might be good for me to share the inner workings of the Rudi I know with the public persona, which of course is always very gentle, softly spoken, and well considered.
Here.
All right. So let me ask this question. We saw the US, a very big rise last week, but we've seen big rises followed by big falls. But the NASDAQ was up 8.5%. Our market's been positive for 3 or 4 days now. Do you think a bottoming process is trying to happen? Not saying it is. I'll get you to comment on that later. But do you think bottoming is trying to happen right now?
I like the careful way which you choose your words, Peter, because you're obviously trying to formulate a sentence to which I cannot just simply take a gun and just put some holes in there. In a broad sense, from a top-down perspective, you look at the macro picture, what is actually happening on the above us. I find it almost inconceivable that this would be the bottom in this market. And the reasons for that are quite simple. central bankers are still tightening, and historically, in particular when they're accelerating the tightening, historically markets find that very difficult to cope with. But the extra complication here is that we are facing an increasingly difficult, and I would say extremely tricky reporting season that is coming towards us. And investors should not be surprised if some of their companies come out with a big swinging surprise. And that can work both ways. We, for example, on the day today, we have a market update by Collins Foods. And yesterday we had one by Metcash. And in both cases, the share price has responded quite favorably, in particular in Collins Foods. So everyone who owns those shares would be very, very happy today. But we've also seen in over the past week or so, in particular, some of the smaller cap mining companies updating the market. And those share prices have actually absolutely been shellacked. I mean, down 20% is almost standard here. And that, to me, those two extremes, they pretty much illustrate the challenges that are now ahead for investors in what's coming. And it's very difficult to predict which company will surprise to the upside and which one will surprise to the downside. So coming back to your question, it is well possible that the markets are trying to bottom here, but I'd be very, very surprised if this is the bottom and this is the end of the process. I couldn't help but noticing there was a little bit of an attempt to have an earlier part of your question as well. And I do think to get that earlier part of your question, I think we might be halfway at best here in this year's process. And I could easily refer back to a recent update on matters by analysts at Merrill Lynch, Bank of America Merrill Lynch in the US. They took a leaf from more than a century of examples and averages that you can establish. And they basically said, if this turns out an average bear market, then it will end in late October this year.
Well, I'm glad you said that, because that's exactly what I've been saying to people, that after, you and I often have laughed and talked about, selling May and come back on St. Leger's Day, which is about mid-Sep. And I've been arguing that probably the time to expect the market to start showing some real positivity will be around October. And I'm also factoring the possibility that, Putin may well have enough of this war by around that time, fingers crossed. I figured China would be out of its lockdown more by October than, July. So putting it all together, I thought the likelihood of seeing inflation dissipate from those cost reasons could be starting to show up by around October, and the market would love that. And also, Rudi, correct me if I'm wrong, but we often see selling before June 30. Then we see a little bit of buying in July, because those naughty people getting their tax losses then buy their stocks back at lower prices that they've often created by selling them down. And the tax office is looking at that this year. Yes. But then we find that when we get to September, August, that can be really tricky for the market, can't it? But then again, from October, November, boom, we go off again. So it seems to me that's a narrative that may easily play out, provided we get good inflation or better inflation numbers, and then we think central banks will be easing up on their rate rises. Is that a story that you think is potentially believable?
I'm hoping for a scenario like that, to be honest. I'm hoping that we are experiencing the peak in central bank dominance over markets, and I'm hoping that within weeks, or if not a few months, that we are seeing the early withdrawals or deflation in inflation numbers, so to speak. Because if those numbers stay high, that would be very, very bad news for equity markets. We do not want inflation numbers to keep on printing 8 point something or 7 point something numbers, that is pretty bad for equity markets. And we should realize that as equity investors. I mean, there is something that we don't have control over. Central bankers are doing their best, but they don't really control supply, which is very important for inflation, and they don't control the war either. No. So they're doing their best at the margins, and so we should all be hoping that the scenario that you just painted that is logical and hopefully plausible.
Yeah. Okay. So we both agree that there's potential for a December quarter rebound, provided the inflation number. And I've been saying to people, you're just going to have to watch the economic data, and therefore, what we're seeing now is, I think, and look, Rudi, I've never really thought about the dynamics of a bottoming process, because people like you and me often talk about it in terms of numbers. We see what's going on in terms of companies selling off, companies being bought, indexes going down. But when you think about a bottoming process, is increasingly more people thinking that that the stocks that have been smashed are starting to look like good value. And these people are early movers. They may be long-term investors who say, well, I might be buying zero at 75, and if it drops to 70, I know it's going to be 100 in a year's time, therefore I'm prepared to cop the loss. But there are a lot of other fund managers who will never do that, because they're accountable to their investors on a much shorter term basis. But it's that toing and froing between, is it time to buy or timing to sell, that explains the bottoming process.
Peter, while I agree with that with that assessment, I think the extra complication this year is, and I know this because I've heard that quite a number of fund managers are nervous about what corporate profits might look like next year. And that complicates the process this year a little bit, because a stock that might look cheap or attractive this year, but if then the corporate profits disappoint next year, it might become cheaper, and that complicates the matters a little bit this year.
Yeah, but isn't it interesting, Rudi? Because in many ways, it just gets down to the decisions by central bankers. How tough are they going to be? And the tougher they are, the slower that the growth will be in 2023. But if they engineer a soft landing, you may well see 2023 being the year where growth starts to accelerate over the year, and then they need to raise interest rates in 2024, and that will be the end of the cycle. Because historically what we see is that stock markets actually rise during the early phases of interest rate increases. It's nearly the second leg of interest rate rises that invariably causes the crash of the market.
Yes, but obviously this time is different.
You said that, Rudi. You said this time is different.
Yes.
Historically, you've always been scared to say that. And I totally agree.
This time is different because we are hiking. Well, we, the central bankers, they are hiking in a slowing economy this time, and also we are only hiking because inflation is running away from us. Otherwise, central bankers would not be doing it. I have to say there was also the other scenario, Peter, in that, and that's quite a popular scenario among some of the analysts and economists, in that the RBA and the Federal Reserve Bank and the ECB, they're all going to be hiking this year, and next year they will be cutting rates again, and it might become quite quickly upon us. So if anything, that almost is a very good indicator for a lot of volatility. We will go up and down a lot probably over the next 16 months, because the picture can change so quickly. And hopefully, when they are hiking into year end, hopefully inflation is responding to the hiking, because that means they can also confidently start cutting again a few months later.
There are so many scenarios, and we always know that economics is never straightforward. There's always people on one side of the argument and the other side of the argument. And from my point of view, Rudi, if there wasn't a war and China didn't go into lockdown, I was expecting this to be a really big boom year. If you look at those charts, I don't know if you've ever seen Shane Oliver's AMP's economic activity tracker, how it shows how economies boom out of lockdowns. And I was kind of presuming that would be 2023. Then 2024, you'd have to raise interest rates. Oh, sorry, 2023, you have to raise interest rates really, really hard. Not this year, but because of the cost push inflation, the central banks have been forced to move probably earlier than they needed to. But anyway, that's all economics. Just forget that. Let's now move to some stocks, because a lot of people always love to hear us talking about stocks. I want to talk about Tyro. Now, to me, Tyro is a good company. It's everywhere you go, and you're a man who occasionally goes into the odd pub, you see Tyro machines everywhere. And at one stage, it was a very, very popular company. And now it just can't seem to do anything right. And it seems to me a tech company that will eventually, someone say, oh, gee, we've probably been too hard on it. But do you think Tyro's problem has also been made harder by the marrying of Afterpay to Square? Because Square, in a sense, is a bit of a rival to Tyro.
Oh yes, absolutely, absolutely, and I suspect Tyro is basically regarded as a little bit as an alternative to the banks, which they obviously have tried to develop. I guess they had a few own goals over their short existence as a listed company. At some stage, they had frozen terminals to deal with, and of course, they came to the market as a fast grower, and then disappointed quite a number of times. I guess investors have a memory when it comes to that, and they have probably put Tyro in the basket of young upcoming technology stocks. And you know how the market works, Peter. I mean, once you have a label and the market doesn't like it, you will be sold, and questions will be asked later. That's just how the market works. I mean, Tyro would by far not be the only beaten down technology stock on the market that most likely has a more rosy existence in front of it than is now indicated by the share price.
Yeah, and it's always, when you got that kind of negativity to a sector like tech, and they're in the short seller list as well, it starts building up understandable reasons why some people will say, too hard basket. When it takes off, maybe in a year's time, I'll get back on board. But at the moment, I'm out of here, baby. And a lot of buy now, pay later companies in that situation. But I want to go to two companies I'm sure you've got a handle on. And I only got into these companies because various of great quality people who come on my program of your caliber have brought them up and have made the point that these are companies with quite internationally competitive advantage technology. One is Megaport, and no one ever tells me that they haven't got an internationally significant competitive advantage, but it was about a $16 stock, and it's like a $5 stock. And another one called Audinate, which I think you've talked about in the past as well.
Yeah.
And in both cases, we're talking about companies that may well not be making profits, but certainly that they don't have any clear-cut competitors. They're really highly regarded in their sector, but because they're in tech companies, and probably because some of them are insured, they really have been smashed. But it seems to me they're the kind of companies, and that's why I'm going to ask you a question, are these the kind of companies that are very tolerant long-term investor could, not should, but we're not giving advice here, could have confidence that eventually they will come good?
Well, let's get back to the start of this conversation. You rightfully said, amongst all the Belgianisms that came across, that I'm a more of a cautious investor, and I'm definitely in 2022. I have presented myself as the cautious investor. One of the things I think I did correctly this year is I removed all excessive risk of my portfolio, insofar it was already there, because I'm a cautious investor under the bad of times as well. I didn't have excessive risk. But what investors should understand, and they may have caught up a little bit too late on that one, is that when the market environment changes from extremely bullish to gradually more and more bearish, and then we get the drawdown, is that investors start looking at investments in a different way, and they start upping their requirements. And one of the key requirements in 2022 is that you are profitable as a company. The companies you just mentioned,
they have big debt as well.
The companies you just mentioned, they are not profitable. So that means that the share price has no support, and it basically is anyone's guess how low it can go. The second requirement, which might alleviate a little bit if you're not profitable, is that you generate a lot of cash out of your operations. Now, between the two companies you mentioned, Ordinate is then definitely of a better proposition than is Megaport. Megaport has the disadvantage of being not profitable, requiring a lot of capital. So it still has to get capital from elsewhere because it invests more than it generates in cash. Yeah. And then it has had a few let's call it operational hiccups. Not major, but for a growth company that's bad enough to set the share price back. So I'd be cautious at this point in time, but just for the reason that on the theoretical sense, if they have to come out in August and say, listen, guys, some of our customers have held back a little bit and they've postponed their transformation by a few more months, then the share price probably gets clobbered again, even though it's not under their control, but they're still in a position that they're not profitable. They won't be profitable anytime soon, and they will still require fresh capital. So the market doesn't like that type of investment at this point in time. Just to throw something in, two of the few technology stocks that I've kept in my portfolio this year are Iris and Technology One. And you can see the difference. I mean, of course, the both share prices have been weak as well, but they've by far not been as weak as the companies that you've mentioned, because they're profitable, both of them, and they're also quite reliable and predictable and forecastable in what lies ahead for the future. And that's more the type of lower risk assets that the market requires, that the market likes in 2022. And of course, the more this process goes on, we're still battling high inflation, we're still battling falling share prices, uncertain future, possible recessions. That's not an environment where investors will happily snap up Megaport, Tyro, or Ordinate. I mean, but what I would say is that, and this is an ideal time for investors. If you like that type of future forward-looking company, by all means, put them on your radar. Keep investigate them, research them, have a look at what exactly is happening, whether you like management, whether you like the prospects. I mean, for example, I would definitely like Ordinate, because this bear market will ultimately give you the opportunity to buy those stocks at very cheap levels. Even if that's not yesterday or today, that might still be the case in 12 months from now. Share prices can still be cheap by then. I mean, a company, as you know, that I like very, very much is Pro Medicus, which is of a complete different nature. And I still think that's one of the highest quality companies we have in the growth space. But at this point in time, also no longer own that stock, because I still think we probably will be able to purchase it at much lower levels. In particular, if this market goes crazy again to the downside, there is no natural protection for those small cap companies that have a lot of promise and high valuations.
Okay, one last question before we say farewell to the great Belgian of Belgium. Rudi, what's the one company now that you think looks like good value, that is worth buying now, and then it's not going to take long to see a reasonable return? What's that one company?
It's a very tricky question, because the reporting season is not upon us yet, and for a lot of companies we can only guess, because we don't really know what's coming towards us. Let me maybe respond to this in a different way. Instead of trying to pick a company, I think there is a scenario, and both you and I don't like it, but it is possible. It is possible that inflation sticks around for longer than you and I now think, and than we would like, and this out of our control, and we don't really know. Now, maybe just as a little bit of a protection and a little bit of insurance against such a scenario, investors might add some gold exposure to their portfolio. not gold miners, because that's specific company risk, but a little bit of gold through an ETF or so. Just have a little bit of protection that in case inflation refuses to come down or as quickly as the market is hoping for, then that gold price should give you a little bit of compensation for the losses you're suffering in all your other or most of the other stocks that you own. And because gold also in what's forthcoming, it doesn't carry earnings risk, rising prices and shortages of staff. It doesn't affect. Brilliant.
And the fair point is this, Rudi. The fair point is that if you don't have any gold in your portfolio, having a bit of gold in your portfolio is not necessarily a bad idea.
No, absolutely not. And treat it as an insurance. I do as an insurance. Don't make it like huge unless you really have a dark view on the outlook for inflation. But a little bit always there, just as an insurance policy. I think it suits the mind a little bit, and it's like having a fire insurance on your house. You hope that you don't need it, but it's nice to have on the side.
Yeah, and even if you're wrong, you're still holding a reasonably valuable asset. Rudi Filapek-Vandyck, thanks for joining us.
Okie Peter.
Well, joining us now is Kelli Meagher from Sage Capital. She's a portfolio manager there, which means she's watching the market very closely and looking for stocks that look like great value. Thanks for joining us, Kelli.
Thanks for having me, Peter.
So this market at the moment, what are you thinking about?
Well, it's definitely interesting times, to use the overused word. We don't have any precedent for this market at the moment, with a coming out of a global pandemic and Russia-Ukraine war, and then massive supply chain shocks and the oil price skyrocketing. It's strange times. We're navigating the markets as best we can, and obviously inflation is the word of the year. We haven't had these levels of inflation since the 70s, and unless central banks get on top of it, the outlook globally isn't good. So. And we saw last night central bankers once again reiterating that they will do everything they possibly can to get inflation under control, which is great for the equity market long term, but short term, that means obviously interest rates going up. And mathematically, that tends to be bad for stocks in the short term, particularly high growth stocks with long duration cash flows.
Yeah. Let's just the problem I find with anything when we talk about stocks is that our focus is terribly short term, because no one wants to buy a stock that looks like good value at $1 when it's been $10 and then see it drop to 50 cents. But that's a short term analysis. Are you looking at this and saying, okay, for most of this year we're probably going to be under pressure? But ideally, if the Ukraine war ends sometime this year and China gets out of its pandemic lockdown problems sometime this year, it could set us up for a surprisingly good 2023. Is that an unreasonable, optimistic scenario if those two things happen?
Well, I mean, I think the equity market could be in for a decent 2023, even if those two things don't happen. But it depends what happens this year. Looking at where the markets are now, obviously the PE ratio, markets US off 20%, we're off sort of 10% so far this year, and PE ratios have compressed. But the thing now, though, is that we need to see earnings take a step down. The earnings and margins out there in the market are still very optimistic, and many of the consensus numbers is factoring in that the good times from COVID that a lot of companies experienced retailers, for example, that their elevated margins are going to continue on and not come back to where they were before COVID. In some cases, that'll happen, but across the market, not just retail, margins are still too high, we feel, and so we are looking at the E coming down. And I think there's going to be a bit of maybe bloodshed in August when companies report here in Australia, and the market may be very weak. But by the end of this year, we may reach if earnings come down to a more realistic level, we may be in for a great 23, but there may be some pain first.
Yeah. So you're kind of saying that if you want to be a buyer for the long term, it may well pay to wait to see reporting season.
Yes, I think so. Yes.
Yeah. And historically, correct me if I'm wrong, but when we see a company report better than expected at reporting season, it invariably, provided the outlook statement is pretty good, you tend to see a bit of positive momentum for that company, even if you miss the first bounce that might happen on the day they announce. It tends to have a lot of positive momentum going forward, doesn't it?
Yes. This time around, though, particularly some stocks like retailers, just because calling those out because no one's interested in retailers at the moment because everyone's everyone's looking down the barrel of rising labour costs, rising inflation, COVID, comping really high COVID goods retail sales. And retailers are going to come out with great results this August because the consumer is still spending. But I don't think anyone's going to care because everyone's focusing on, well, what happens in a year or in 23 when $500 billion of mortgages roll off fixed loans. So that is going to be a big crunch time for spending and retail in particular in 23.
Yeah. Okay. So given the fact that, in a perfect world as a portfolio manager, you want to buy cheap and see the stock prices rise over time.
Yeah.
Are you able to take a long-term position, or because ultimately you're accountable to your investors on a more, at least half-year basis, maybe even less than that, is it difficult for you to take a long-term position on a company that really has been smashed?
Well, no, because we do that all the time. Yes, the nature of our fund is we're quant and fundamental, and we're always adjusting for new information in the portfolio and adjusting positions. But an example of where we're taking a longer term view is we've been buying Domino's recently. It has more than halved. It's gone from $160 to 67 at the moment or thereabouts, and that they've got some pain coming. They're not at all immune from they've got rising labour costs, they've got rising energy costs, they've got rising food costs, a lot of things to fight. However, we think that they're going to navigate their and be able to push price increases through better than most. They've got a good scale, compared to a lot of their competitors. They've got the tech, they've got great management team, and still have global growth. And looking at it, putting in a risk-free rate, sorry to get technical, but doing a DCF on the long-term cash flows, there is a margin of safety there where you kind of go, well, okay, even if they report in August and it's looking disappointing, and they talk to long-term, the next year being very tough. The valuation is still, there's still a margin of safety there. We go, over the long term, this thing is still going to grow, and pizza's a great place to be in a recession. If we're going into a recession, those fancy Uber Eats orders will drop like a stone, but people will go and still eat their Domino's.
Yeah, good point. Is there a tech company that you think has been over smashed?
Well, one that I like is REA, which is as I think everyone knows of REA. That it's been smashed, and people are worried about listings rolling over and the property market tanking. And that's one that's been absolutely hammered. And but they've got great product. Rollout coming through. They've got a lot of price. They're the leader in the market, so their pricing power is huge. They've got their price rises locked in for next year already, and they've got a really flexible cost base. So even if Armageddon happens and listings completely roll over, and they struggle to get some price increases, say in 24, because they're not a fixed cost with large fixed cost based business, they can cut back on marketing, they can cut back on some of maybe their tech spend and still achieve decent margins. And history shows that with that one, the time to buy it is when everyone thinks that the real estate listings are going to completely tank, and over the long term, you'll make good money. Yeah,
because when house prices fall, you often find people trying to sell their places to try and beat the further fall. So the actual listings can actually increase during a time of falling prices. This was explained to me by the CEO of Domain, who clearly has a vested interest in saying, well, the market probably is exaggerating how bad it can be for us because of that reason.
Yeah, exactly right. Exactly right. So, and people, when I guess there's more competition to sell your house, when there's a lot of when buyers are a bit more reluctant, you may be more willing to pay up for the extra promotional ad to be at the top of the screen and things like that. So they get yield. They talk to yield, basically premium pricing for some of their ads. So it's with a long-term view. Not saying it's going to skyrocket by the end of this year, but with a longer-term view, that one is it's a great company.
Good, and it kind of fits the quality tech story, doesn't it? Because they do make profits, and I guess car sales fits into the same kind of category, though not probably as safely as REA does.
That's right, and we're not a huge fan of the recent buying out Trader Interactive. A little skeptical on the timing and the price and the motivations for that. So we're definitely more keen on REA at this point.
Well, one interesting one I'd like to ask whether you've thought about is a company like Tyro. Now, yesterday the CEO resigned to go to Star. I thought the CEO was pretty well on death row anyway, considering what's happened to Tyro anyway. So it was a pretty fortunate exit for Robbie Cook to go to Star. But to me, I suspect Tyro is seen as a buy now, pay later company, but it's not a buy now, pay later company at all. And the share price is unbelievably low. Have you guys run your eye over a company like Tyro and made a decision either way?
So and I had a feeling you were going to ask me about Tyro. My colleague is the expert on that one. We have in the past been both long and short Tyro. At the moment, we don't have a position there, but we were closely watching when Robbie Cook resigned, and there may be an opportunity there, but it's not one that we're actively have a position in at the moment.
Is that because the whole tech payment space is like, and this is a thing I find interesting, Kelli, and you've been watching markets for a long time. It doesn't matter how good the company may well be or what the potential might be. If the market just doesn't like it, it's just difficult to take a position because the market might not like it for 2 or 3 years, despite the fact the company actually does okay.
Yeah, and I believe the industry structure plays a big part, and if there's a belief that margins are going to be being compressed over time, then that's a hard fight to win if you're a company playing in that industry. So
All right.
but there's a price for everything. And so maybe we should follow your footsteps, Peter, and buy some Tyro. We'll see.
Oh, no, I'm not recommending it, but still, it just seems to me everywhere I go. And I'm not going to say I have got a position in Tyro. That's why I'm interested in it. But the bottom line also is, every time I go to a pub or a cafe, I see a Tyro.
Yes.
And it just seems to me that it's a company that probably has a future. Even a takeover target seems to me, why wouldn't a bank think, well, this is a competitor that's now unbelievably cheap. And we often do see this, don't we, that companies that had potential and the market really smashes them, they then all of a sudden, you wake up one morning, the headline is, takeover target and so on and so forth.
Yes, oh, look, totally. And it'd be interesting to see what happens with M&A activity from here. There's been some big changes in the cost of debt and the market and outlook economically in general. So in the last few months, 6 months ago, would have been saying that it's great. There's going to be a lot of M&A activity this year, but it's I think the numbers have to be revisited, and there's a lot of investment bankers running their rulers over deals they thought might have looked attractive a few months ago. It may not look quite as attractive today. Be interesting to see.
Interesting times, Kelly. Thanks for joining us, and good luck going forward.
Thanks, Peter. See you next time. Bye.
Well, with further interest rate rises imminent and the cost of living increasing, many Aussies are understandably struggling and worried about how they will continue to afford living comfortably. However, one lesser known investment method is actually putting more than several $1,000s a year back into the pockets of everyday Aussies. And it's not what you might think. We're talking to Helen Tarrant from Unicorn Commercial Property. Helen, thanks for joining us.
Nice to be here.
So Helen, just before we start talking about this other way of making money out of property, what's your take? You've seen predictions of 30% falls in house prices. Do you think that this is on the cards, or do you think it's a little bit over the top?
I think that 30% is probably a little bit over the top. I think somewhere between 10 to 20 is probably expected, and I think that's maybe what the market is expecting. I think if it went to 30, people go into a bit of a panic and start basically going fire sailing because they feel like their property have all their wealth wiped out. Yeah,
and I think it's fair to say that, and the guy who's most famous for the 30% call nowadays is Chris Joy. One thing Chris doesn't say, he doesn't say over what time period. So I guess if house prices fell 30% over a 3-year period, it wouldn't be as bad as if it was 30% in the space of 6 months.
That's true. The last time that something like this happened, like about 10 years ago, what I found was that a lot of properties in the top end of the market fell by quite significant. But at that time, top end of market on a North Shore in Sydney was like 5 or 6 mil, right? Today, that same house is probably 10 mil. To 11 mil, right? And compared to the houses that didn't fall, or maybe only fell 10%, was properties out west that was anywhere from 700 to 900,000. So it depends on where you are and the fall, because when you're buying a $10 million house, like 30% fall is quite significant. But also there's not a lot of people that can afford to upgrade.
No, but also we always forget that when a place falls, say 3 million on 10, it's probably risen 4 or 5 on 5 in the preceding years. And when you make reference to 10 years ago, I remember, the great properties at Palm Beach in New South Wales, some of those fell 30, 40% during the GFC, but they quickly rebounded as well.
Yeah, I think a lot of them have and gone on to be even more. Right? When we look around, only recently I was talking to a client of mine, and they've recently bought into Noosa, right, at 5.5 million for a house that still needs renovations, $1.5 million of renovations. But somewhere down the road, a fully renovated house was selling for 10. And you think, oh, wow, I'm sitting here in Sydney thinking, wow, you're buying in Noosa for 5.5 mil.
Yeah, well, but during the GFC, Noosa properties really became cheap. So I guess there are properties that are property areas that are very volatile, and others kind of hold around a mean or average price. But let's go to what you're looking at now. Your name of your business is Unicorn Commercial Property. So you clearly like the space of commercial property. What are you seeing there, and what kind of people are getting into commercial property nowadays?
So for the first time, a lot more residential investors are coming into the commercial property space. Before I got into commercial in 2012, so 10 years ago, and back then it was like a secret club. You know, if you didn't invest in commercial, you know, people didn't talk about it, right? And you only got into commercial because you keep bashing on the door and someone told you about it, and you got in, you did some investments, and then you sort of rolled on from there. Now it's becoming more mainstream. You know, accountants and lawyers are recommending it to their client, financial planners are recommending it to their clients to invest in their self-managed super funds through commercial property, or that they, you know, if they need, they're too negative in their cash flow when they have a resi portfolio, to invest in commercial to get some cash flow. So it's become a lot more mainstream, and we're seeing a lot more residential investors coming into the commercial property space.
So let's just talk about commercial property so people might not fully understand what it means. What is commercial property, the definition of it?
So the definition of commercial property is that it is your warehouse, industrial properties, plus your retail shop fronts, you know, your cafes, your hairdressers, your dentists, your office spaces where you might go and see your accountant, your financial planners, or somewhere that even might be a government office you go and visit, right? NDIS, disability services, all of those things are considered commercial. Okay. Now, what is not considered commercial, a lot of people are confused about, is things like boarding houses or things that has your traditional where they have sort of backpacker accommodations, okay. Or in some ways motels and hotels are traded so separately from the commercial, the general commercial space. Okay,
so what is the big appeal then of commercial property? Because I'm actually thinking to myself, you know, where I live, our local shopping area is now packed every morning of all those workers who used to go to the CBD and who are now working from home. And all those shops along there, the coffee shops, the news agency, they're all doing a lot better business because of the post-pandemic trends in the workplace and in the labour market. And I figure all those places are now worth more because they can just produce more income. Is that true?
Absolutely. Commercial property works on supply demand. So it's not as sensitive to interest rate rises as most people think, because residential it is, you know, when interest rate goes up, the property price comes down, and then vice versa. But in commercial property, it's worked on supply and demand. So at the moment, because of so much residential investors coming into the market, there is more demand and less supply. There's probably 4 times demand to supply. So what that equivalents to is that the returns keeps going down, the value keeps going up. But one of the big things that happened during the pandemic is that it made people realize they need to shop local. Like their local stores actually have everything they need. So people no longer traveled to places to get specialty goods. They started shopping locally, going to the local cafes and supporting local. And as a result, on-flowing result, these businesses have boomed. And more people working from home, more people moving into suburbia or even regional have now started to push up the rents, and on-flowing effect, value of the property goes up.
What are banks like lending to investors in commercial property?
Banks love tenanted properties. So they don't like properties that are vacant because they feel in this current market, they don't know when they're going to be getting the income, and they're looking at the investor to service a debt. So that for them is not secure. So they love tenanted property. So you got a tenant that might be a bakery tenant, a dentist tenant, any of those, your local shops that you see around your area that's been there for established history, you know, 5, 7, 10 years, and they're in the middle of a lease, and they're in the middle of another 5-year lease. Banks love those. They write those deals every day of the week, and they give really favorable loans and really favorable rates.
Okay, so if you look at commercial lending rates compared to residential, what's the interest rate differential?
It used to be, believe it or not, when we first in 2012, somewhere around about 1% to 1.5%. But today, the difference is most 0.5%. So on a standard property, you're looking at somewhere between 3 to 3.5% in interest at the moment in this market. And I think most resi loans are going to sit somewhere around the high 2s, the early 3s. So we're sort of about 1/4 to 0.5% difference.
Okay. Tax deductions, are they bigger with a commercial property than with a residential investment property?
Slightly different, but those things you can't claim in residential, you can still claim in commercial. So, you know, going up to see your properties, and sometimes there's deductions on sort of your fit outs and outgoings that can't be deducted in residential. You can still do that with commercial. And also you can still do depreciation in commercial like you do in residential.
Okay. What about GST? Is there any GST differences between residential and commercial?
Yeah, that's probably the most significant difference. So a tenanted commercial property is what they classify as a going concern, which means it is GST exempt. But in order to take advantage of that, the purchaser, as well as the seller, but the seller normally is anyway, have to be registered for GST to get the exemption. And then if you are purchasing a property, say a couple of million, and the rent's over 75,000, you have to charge your tenant GST, and you have to then pay the GST back to the government.
But that means that any GST that you pay, you get back as a credit.
Absolutely. So any GST you pay on your outgoings, refurbishments or capital works, you get as well. So it's a bit more accounting compared to your residential. Maybe sometimes you can't use a spreadsheet anymore. You have to migrate to MYOB, but certainly at the end, you get more cash flow in your pocket.
Okay. We often hear people in your industry talking about the average yield on commercial property. What is that average yield now for commercial?
So that's definitely changed and compressed a lot since the pandemic. So what we're seeing now in metro areas, so for example, Melbourne, Sydney, we're seeing between 5 to 6% yields on office space and retail space properties. We're seeing somewhere around 3 to 4% yields for industrial properties in Sydney and Melbourne. Out in regional areas like where we're talking about regional Queensland, New South Wales or Victoria, where anywhere is between around 6.5 to 7.5% in terms of a yield. And when you're looking at Brisbane, Gold Coast, Sunshine Coast Strip, they've had a lot of boom during that time. And they're sitting somewhere around the 5.5 space.
Okay. Would you be cautious about investing in office space nowadays because of the work from home trend and the fact that a lot of landlords are aren't in the same strong position when it comes to their tenants?
I think it's a renter's market right now. If you want to be renting in the CBD, right, they're giving amazing incentives. Like, so on a 5-year lease, you could be getting a year rent free, right? Because that's where the market is. There's not a lot of people want to rent, and also something that there's probably a 20 to 30% discount on rents as well, because again, it's a renter's market. But I think that if you are in a position to buy right now an office space, I think it's actually a great investment, but provided you can tolerate the risk, right? If you can hold for the next 2 to 3 years and let the market come back, let people get used to, that hybrid working, smaller office spaces, but, people working half a week in hot desking and all of those co-hubs, working hubs, I think office space will come back to its vibrancy. And it's sort of like a bit of a circle. Sort of at the moment, they're pretty much at the bottom of the market and they will rise. And I think whoever invests in commercial space right now, they're going to have capital gains in the future, 2 to 3 years' time. And that's going to be quite significant when the rents jump back up.
Yeah. Do you think two things, in my head, I think two things could happen in CBDs. One is there'll be a lot less new building because of the oversupply, because there's less demand. But also, do you think a lot of office space could be converted to residential, which will also help your supply scenario tightening up over the next few years?
I do actually think that in fringe CBD areas, a lot of those could go into a residential space. So they come into residential loft apartments. So a lot of them might be the old post office building or the old NAB or bank buildings, which is heritage listed on the front. And they can't really change that, but internally they can create quite a few levels of apartments, and it actually creates very convenient for people to access universities and work.
Yeah. Are you seeing any incidents of people maybe buying a retail premise and like the old Victorian ones always have accommodation above, and they're actually renting the bottom out to a business and maybe doing Airbnb in the apartments above and getting multiple income coming from it?
Well, I always advocate for multiple income or finding ways for multiple income. So with something like that, that there's car spaces they can rent out, because people who live in the city most of the time are tramming it, so they don't really need it. If they actually can, the investor can create a separate entrance. The main thing with those things is entranceways and access to amenities, right? So if you can get bathrooms upstairs, bathrooms downstairs, entrance from the back to upstairs, you can definitely Airbnb. It's just a bit of rejig of that.
That's right. All right. Thanks for joining us, Helen. I guess the bottom line is, over time, we're going to see some changes, but you think commercial property is going to be pretty strong for the next few years?
Traditionally, commercial property continues to grow for 2 years past when residential stops. And a commercial property is going to fare pretty strong because it's going to give you cash flow straight up. And in a time where we need a lot of cash flow, most people are going to gravitate to the cash flow rather than buying a value asset.
Yeah, great stuff. Thanks for joining us, Helen.
No worries. Thank you.
And before I go, let me remind you, on Wednesday, we have another one of our small and micro cap conferences. It's on Wednesday. Have a look at the link on the screen right now and make sure you join us for this, where CEOs and MDs of small cap companies talk about their companies and what might happen in the future. Once again, see you on Monday night.